With more than 6,000 small and micro-cap companies listed, if you're looking for the next Apple at the earliest stage, then ChannelChek truly is the orchard. The listed companies support ChannelChek, so it's free for you, the potential investor, to gain access to institutional quality research from FINRA licensed analysts, advanced market data, industry reports, news, and a growing catalog of videos and webcasts. Make sure to subscribe to our YouTube channel and register for ChannelChek so you're always up to date on what's going on at the small and microcap data place. Welcome to the virtual Roadshow series presented by ChannelChek. This Roadshow features Stamatis Tsantanis, CEO, and Stavros Gyftakis, CFO of Seanergy Maritime Holdings, NASDAQ ticker symbol SHIP. Following a formal presentation, they are joined by Fratt, Senior Research Analyst for Noble Capital Markets, a FINRA-licensed, SEC-registered broker-dealer, for a Q&A session featuring questions that were submitted by the live audience. You can find Noble's research on Seanergy on channelchek.com or by clicking the link in the description. With that, I am pleased to present Stamatis and Stavros.
Thank you, and thanks very much for Paul and for the Noble team for arranging this, and thank you for hosting us. Good morning, good afternoon to everyone. I'm here to present Seanergy Maritime Holdings. I'm here today with our CFO Stavros Gyftakis, and we will try and walk through the main points of our presentation, and then we'll have time for a Q&A session at the end of the slides. So I'm starting by saying that Seanergy is the only US listed pure play shipping company, pure play with a Capesize fleet. For those of you that are not familiar with Capesizes, this is the largest conventional size of ships in the dry bulk segment, and we transport mainly iron ore and coal. As you know, iron ore and coal are the most important commodities for the infrastructure investment, which is now happening globally, and it will continue to happen in the next few years. We have been listed on the NASDAQ stock exchange since 2008, and our ticker is SHIP, S-H-I-P. We have a modern, high-quality fleet of vessels, a very experienced management team, solid corporate governance with no related party transactions, long-standing commercial relationships and partnerships with some of the world's largest names in the business. We have a very fundamental commitment on ESG, and we have one of the lowest, if not the lowest, asset acquisition cost among the competition and a very low break-even. Moving on to the next slide, here's an infographic of the company where you can see that on our website, and you can study it, and we will discuss these points, the main points of that infographic during this presentation. This is the fleet list of the company. As I mentioned before, we have a homogeneous fleet of 16 Capesize vessels. The total cargo carrying capacity is 2.83 million deadweight tons, so it's a very sizable transportation, water transportation of commodities. All of our ships have been built at some of the world's best shipyards in Japan and in South Korea, and most of the fleet by far is trading on a period employment which is associated with the indices of the market. A very brief history of our organization since 2015, which has been the relaunching of our operations. We bought our first Capesize ship at the lowest point of the cycle in 2015, and we have been growing, as I mentioned before, at the lowest, we have one of the lowest, if not the lowest, acquisition cost in the industry. Over the last, over the last 5-6 years, we have invested about $440 million, and just in 2021, so far we have invested $160 million for the acquisition of ships. Brief info of myself and Stavros here, as well as our board of directors that are all very experienced, independent members that are all, they have an aggregate of more than 100 years experience in shipping and finance. So as you can see, this is a very capable management team and a very capable and independent board of directors. A few words about our commitment for the ESG before we get into the discussion about our business. As I mentioned before, we have a very solid ESG commitment. which is not only for the environment, which is of course of utmost importance these days and for quite some time now, but also on a social perspective for seafarers as well as for governance. Very briefly, we have been investing and cooperating with some of the world's largest charterers since 2016 and especially since 2018 in reducing the emissions of our fleet by making our vessels more efficient. So while people are trying to investigate and invent what the vessel of tomorrow is going to look like after 2030, we took the initiative to reduce the consumption of our ships and the emissions of CO2 today. So we have started investing in some of our ships with energy-saving devices in cooperation and partnership with some very big and recognizable names. At the same time, we have installed telemetry, we have installed artificial intelligence systems, and we have been one of the first in the industry to do that, especially from the dry bulk segment. At the same time, we have signed the Neptune Declaration for the seafarers' well-being, because we strongly believe that our seafarers are key people of our family, of the family of Seanergy. So we want to make sure that we take good care of our people. We provide medical insurance for them and their families, and we're always next to them if anything arises that requires our attention. Talking about corporate governance, so the company has never had any related party transactions in respect of commercial and technical management. We are one of the very few companies out there with this kind of arrangement, no side business and no related party transactions. The company is audited by E&Y. We have a very transparent corporate structure and shareholder structure and a single class of shares, so there's no different class of shares voting for different things. So we're very transparent on that as well. Moving on to the following slide. Here we have a list of our key partners and some major counterparties that we have been working very successfully in the last few years. With some of these names, we have been doing repetitive businesses with high success, and with some other names like Glencore, Uniper, and Cargill, we have built partnerships where not only they have been commercially operating our ships, but at the same time they have invested on the ships to install scrubbers, energy-saving devices, and whatever else we agree in the future to make our cooperation even more productive for all of us. 87% of our TCs, of our time charters, are index linked, so that gives us a great exposure into the upside. All of our charters are first class, as you can see here. We have a very diverse customer base, and we are considered to be one of the top shipping companies for them to do business with. Stavros is now going to discuss briefly about the senior lending facilities of the company. So Stavros, go.
Thanks, Stamatis. Good afternoon also from my side. In the next slide, you see the financing portfolio basically of the company. It comprises of 5 loan facilities, which you see on the top of the table. And then in the last 3 rows, you see our finance leases. Our lenders comprise very well-known names in the ship finance space, spanning from local Greek lenders to international European lenders, US credit funds like Entrust, and some lessors from China. We have also concluded 2 leases with Cargill, the very well-known charterer, one of which was also awarded as the most innovative deal by Marine Money, a very well-known shipping publication. Now, the total financings, the total vessel secured financing as of the end of August amounted to around 210 million, which compares with market value of our fleet at that time of around 460 million. So this results to a fleet loan to value of around 46%. Most importantly, in the next slide, you can see the progress that we have marked over the last 18 months in deleveraging the company very aggressively, and this has happened next to our successful growth strategy. So basically, instead of just prepaying debt, we have chosen to acquire second-hand vessels from the market and leverage them very conservatively and moderately, and that has resulted in the gradual deleveraging of the company. In the graph on the right top side, you see that corporate leverage from as of the end of 2019 was in excess of 100%. Today it has improved to 50%, and we expect this figure to improve further as we take delivery of ships, which we finance very, very conservatively. In the left bottom graph, you can see the progress that we have made on a per vessel basis. There you can see that the senior debt per vessel has decreased impressively from 20 million down to around 12.5 million today. Junior debt per vessel has decreased from around 2.5 million per ship to basically nothing today. We have no junior debt outstanding, and also the convertible debt that we have has decreased from around 4 million per ship to around 2.4 million per vessel. In the next slide, a few words about the capitalization of the company. This has again increased impressively from the 280 million as of the end of last year to around 420 million, so that's more than 50% increase. Our share price currently trades at around 125 to 130, and it's and again we have seen some significant progress there from around 50 cents that we were trading as of the end of last year, and there's still some way to go before we reach actually our fair value. Lastly, in the next slide, you will see some financial highlights. Comparing the second quarter of this year to the second quarter of last year, you will see again an impressive increase in our time charter equivalent, an impressive increase in the net revenues and the net income figures. And this is not capturing the full strength of the market and the full transformation of our company, because as has been mentioned in our earnings releases, we had some fixings which were carried over to the second quarter, some not so favorable fixes from previous quarter, which are all done now. So basically we expect that our figures from the third quarter onwards will capture the full upside of this market. With that, I will pass the floor back to Stamatis to discuss a bit the outlook of our market.
Stamatis. Thank you, Stavros. Thank you. Moving on to the demand and supply fundamentals. We strongly believe that our industry and our sector has come into this historical favorable opportunity now, because both demand and supply fundamentals appear to be at an excellent combination. First of all, demand for seaborne transportation services is going up. We see very, very strong demand for commodities like raw materials like iron ore and coal. The main reason is, of course, the global infrastructure growth and the government stimuli that has been trying to basically expand the world horizontally, as it has supposed to be happening for the last few years. As you know, in the US, the government has just recently approved the infrastructure bill, which is going to be another $1 trillion of infrastructure just in the US alone. So we consider that iron ore and coal not only are at very strong pace right now, but they will continue being in very strong demand for the next few years. What is most spectacular right now is the supply of ships. We are now standing at the lowest point of new building orders for the last 15-20 years, and given that we expect the new environmental regulations to be enforced from the 1st of January of 2023, people are generally skeptical in building new ships. So we don't expect any new building activity to happen anytime soon, because nobody knows what the vessel of tomorrow is going to look like. And with that, having that in mind, we don't really see how people can be building ships that might be redundant and obsolete a few years down the road. So this is going to put a lead into the new building activity, and at the same time is going to effectively reduce the effective speed of the ships, which is expected to create a very strong supply squeeze. And right now the market is trading at around $40,000 to $50,000 a day, without taking into effect this supply squeeze that I mentioned before. We expect that in a few months, in 2022 and especially from 2023, to see that squeeze taking place, and that's going to drive freight rates much higher than what they are today. Here we have a very brief analysis of what has happened the last 5 years. As I mentioned before, the company relaunched its operations in 2015, and we have had a very volatile market over the last 5 years. However, the trend is, as you can see here, obviously much higher and upwards. So we expect that trend to continue, and we expect the Seanergy and our shareholders to benefit for this upward trend for many quarters to come. On that note, I wanted to conclude the presentation by saying that Seanergy is optimally positioned to take advantage of the market upside. We have a very strong market ahead of us. Cash flow is very strong. Like Stavros said before, we expect the following quarters to be, at very good levels compared to the previous year. So that is going to be reflected in our financials, and hopefully our shareholders will benefit from that. On that note, I would like to thank you for listening to our presentation, and we're here to discuss any questions that Paul or anybody else has. Thank you.
Let me ask just a couple questions about the overall market. You mentioned that infrastructure and stimulus continues, and that's pushed up or created good demand for capes. Can you just talk about any concerns that you have moving forward about the Chinese potentially curtailing steel production? And then also, if you could talk about that in the context of there's typically seasonality in the market, typically towards the end of the year and towards the start of the new year, there tends to be seasonality. Can you just talk about sort of what you're expecting this coming year?
Yes, thank you, Paul. Thank you for the question. Well, obviously, there's always a concern that China will try to put a lid on steel production. However, at the same time, it's one of the most profitable trades right now, considering that steel margins are at $100 or more. So as you can understand, I don't really see how that is going to be reduced through any government, since it's a very profitable business. And at the end of the day, Paul, China is exporting 54% of the global steel capacity. So basically, more than half of the tons of steel that we're using in our daily lives, in whatever we do, it comes from China. So it goes without saying that this will likely continue to be quite strong in the next few years. But a very strong driver right now from demand is not only iron ore. The market has been very volatile and seasonal because it was dependent on iron ore, and it followed the natural stocking and destocking phase of China. Right now, the market for the last year or so has started to be very strong again on coal, because metallurgical coal and thermal coal as a source of energy and, of course, to produce steel has become a dominant commodity, as it always was prior to the boom of iron ore. So that has helped a lot the seasonality to be tempered a little bit. So we don't see the seasonality. That's why Q1 and Q2 this year we saw this strong market, because it was mainly driven by coal. We see coal to continue to be a very strong driver for demand, because China as an energy factor and various other countries in the world are still dependent on coal, and they will continue for the next few years for their energy production. So we don't really see that coming off, and that is also evident in the price, which, excuse my expression, but it has gone crazy, the price of coal these days. So that being said, the market is not dependent on just iron ore, it's also dependent on coal, and that is going to help the seasonality of the business be a little bit smoother, to put it this way.
Okay, and then Stamatis, could you address, what some of these factors like congestion and or the trade tensions between China and Australia, what impact have you seen on the Cape market?
Yes, we have been hearing about congestion on dry bulk, and that's effectively a big issue for the smaller ships as well as the containers. However, on the Capes, to be honest, Paul, we have not really seen this congestion element so much. I mean, the turnaround of ships, as far as we're concerned, and we have a sizable fleet, both in China and in other parts of the world, has been pretty much what it was, last year or the year before. So we don't really see any major delays on the Cape terminals. I mean, our ships can go in and out as quickly as possible. We have seen congestion. So our market has not been affected so much about congestion on the Cape. So it has been quite strong without the congestion element that you see on the smaller ships like Panamaxes, Supramax, and Ultramaxes, that indeed there is congestion there. But we're not affected from congestion.
Okay. And then, one thing that I've been a little bit, surprised about is just the Cape rate volatility. Stamatis, can you talk about just how volatile rates have been? And then also potentially, can you talk about whether any shippers are giving you feedback about how high rates have moved?
Well, as you know, we're on the opposite side of the table when it comes to our charter. So it goes without saying that our interests are not necessarily aligned. We want to see freight rates going up. At the same time, they want to reduce the transportation costs. At the same time, being in a partnership for so many years, we have a good understanding. And in my opinion, they all understand the tsunami of environmental regulations, which is going to come in 2023, and how this is going to affect transportation of raw materials. Because something that I didn't mention before, Paul, is the fact that right now the ships are trading at 2 or 3 knots, which is effectively 20 or even 25% speeds higher than what they did a year and a half ago. So not only we're not affected by congestion, but at the same time, the ships are going faster. So you have more effective supply in the water. When that goes away with the new environmental regulations, you will reduce the effective supply of ships, and that is going to create a supply squeeze that I mentioned before. So in my opinion, and it is a common strong belief that the markets and the rates will go much, much higher once that comes closer to effect towards the end of 2022. Volatility, to go back to your first question, is of course a big issue. We try to smoothen that volatility as much as we can by converting some of our floating rates into fixed and putting more and more ships on time charter. We lose some of the upside, but we are protected more on the downside. So far, that has worked quite well for us. Not so much in the first half of the year, but in the second half of the year, it looks like we are well into the money. So we'll try to reduce that volatility by putting more and more ships from floating to fixed. However, we believe that this volatility is temporary. We will see very volatile market in the next 6 months for sure. But after that, we will see an ever-rising market at much higher levels.
And then, Stamatis, can we be a little more specific on, you're going from floating to fixed? And sort of how do you approach that? Do you look at a specific absolute level of rate, say like $40,000 a day, or is it just based on sort of what you think, or is there just another way you approach it? And then if you could just highlight whether any of your fourth quarter has been locked in at this point in time.
The answer is yes. We have locked in some of our ships in fourth quarter as well, and we've also locked in some of the Q1 as well. So we have done that. We have not really announced it yet, but soon we will make an announcement. So yes, Q4 we have locked in some tonnage in the high 30s. Q1 we have also locked in some ships as well. So we try to do that. The strategy is that when we see, because as you know, there is a mispricing of the spot rates with the forward rates. So when we see forward rates that we like, whether that is 40,000 in Q4, which we have not really achieved yet, or low mid 20s for Q1, we tend to go and grab them as much as we can. So this is what we do. We don't have like a magic number, but we try to, when we see peaks in the futures, we just try proactively to do it.
Yeah, but so it's more dynamic.
Yes.
And then I got a question from the field, Stamatis, on just the, one thing that we're starting to hear recently is that some of the container cargoes have potentially shifted onto dry bulk vessels. And one, do you see this becoming more widespread? And then secondly, do you think that could accelerate the supply squeeze that you see coming, out 12 to 18 months?
Paul, to be honest, we have not really seen that, on Capesize. So there might be some containers on smaller ships, but we have not really seen containers being transported on Capes. There were some rumors, but they have not been, they have not been substantiated. So I cannot really comment on that because, there's no example that I know so far of this thing happening.
Great. Yeah, it seems to have hit on a slow news day, so to speak. August tends to be like that. When we look at, you've grown, you highlighted that you've made several acquisitions, you've grown your fleet to 16. You just sold your oldest vessel. Can you just talk about, growth going forward? And then also in the context of, asset values moving up, which is a double-edged sword, it makes acquisitions more expensive. Can you just talk about sort of what you're seeing out there relative to your growth plans?
Yes, of course. Well, obviously we have grown the company by about 60% in a year alone. So that has been a very, very strong growth that we have managed to achieve very successfully and very well-timed acquisitions. And that goes very, very well with our previous history that we have bought our ships cheaper than most of the competition, if not all of the competition. In the future, we will continue to cherry pick assets if those come available. We're not against that. If we see the opportunity, we might go ahead and do it. But I think that we will focus now more and more in returning some capital through various forms, either through buybacks or other ideas of distributions to the shareholders. So for us right now is to reduce the leverage, which we have already done very successfully, thanks to Stavros and his team, and the capital raisings that the company has done. So from a capital structure point of view, we're in a very good leverage perspective. All of our new acquisitions have been bought at very, very conservative leverage levels of about 15-20%. So, leverage is on the very low side. Expansion might happen if the right opportunity comes across with no dilution. And our focus is also to reward our shareholders as much as we can.
In that context, Stamatis or Stavros, you do have, I guess at this point in time, the world ship is the unencumbered Cape within the fleet. Can you talk about how you potentially would finance that growth? Would it be, potentially a combination of, levering up any potential, acquisition that you make in addition to, putting some debt on the world ship? And then also, what you just mentioned, dilution. How would you measure dilution when you're making an acquisition?
You want to start with the funding end?
So, thanks for your question, Paul. So, what we envisage to do for the world ship is basically pretty vanilla. A conservative financing, bank financing. We try in every financing that we do, to beat the previous interest rate, to improve on the interest rate. And in the case of the world ship, we are envisaging also something which might entail a sustainability element, because the specific vessel, she's one of the youngest in our fleet, built at the top yard, so and chartered by a very good charterer. So the sustainability element in the financing would be a very good fit. Now, when it comes to how we will utilize the funds, as Stamatis alluded before, be it for buybacks, be it in cleaning up a bit the capital structure. But to be fair, we are happy with the leverage levels of the company right now.
Yeah. Also, when it comes to dilution, Paul, we did what we did in the previous periods in order to be in the position to expand as much as we can right now. And with very conservative assumptions, this company can be making in the region of $10 million per month in cash flow, in free cash flow. So, we can potentially fund the growth from the cash flow, but we're not going to spend all the money the company is making into new acquisitions. We don't intend to do that. But cash flow is very strong. Cash balances and reserves are expected to be very strong until the end of the year. So surely we can fund additional acquisitions and make distributions at the same time. So, we can do it if we want to. We're just being very conservative in our approach because after having passed 5 years of about, very, very bad markets, we want to be very cautious into the outlook of the future. So yes, we're having a very good period right now. We're cautiously optimistic that this is going to continue. We have strong cash flow and strong cash balances, so we can do both, expand on a moderate pace and distribute some capital back to the shareholders. So this is pretty much what we are contemplating.
Great, thank you. I think you addressed the F3 filing on your last conference call and said that it was, a formality from the standpoint of refreshing the shelf registration to give you the flexibility if your stock price went to the right level to issue equity, and you pretty much said that you weren't going to issue equity anywhere close to what the current price is. Can you talk about what drove the decision to implement the stock buyback program, recently, and then, where, if you have, decided to buy any stock back, or have you moved forward on that? That would be helpful, Stamatis.
Yes. Well, first of all, with the F3, as you know, this is a universal shelf. It's not only for equity offering, so we can use it for convertibles, bonds, whatever we want, and it's part of the normal course of business of our company, as well as it's a pretty standard for all the shipping companies. We do not have any immediate intention to raise any equity or any future intention to raise any equity right now. So just this is in place in the event that it becomes necessary. It's a 3-year filing. So we have it there. It's part of the company's plan in all respects, and we have to have it, like everybody else has it, and it's part of the normal course of business of the company. Going back to your other questions, you want to take that?
Yeah, of course. But, first of all, I agree with Stamatis, corporate governance to have a live F3, on file.
Yes.
Now, going on the buybacks, there's a thin, when we're looking at our buyback strategy, there's a thin line between, looking to buy back shares and looking to do something with other instruments that can potentially generate shares that are in our capital structure. So, we envisage to execute on the buyback when the share price stands at least at a discount to our convertible. If it is at close to the levels of the convertible or at a premium of the convertible, for us, it makes more sense to do something on the convertible. There's an internal debate and we're strategizing internally and with our board these days on what to attack first. But we are looking at both things. With the same weight.
Great. That, sort of, I was going to ask the next question, which is, could you talk about the convert? And, with the strike price at $1.20, it seems like it's been a little bit of an overhang for the stock. And can you maybe expand a little bit, Stavros, on your potential avenues to retire some of that convert?
We're taking a more holistic approach on that, and that includes potential future acquisitions, general distributions, and the convertible. So these are the 3 main points right now that we're all discussing internally with advisors and the board of directors. So the quick answer is that we want to eliminate whatever overhang it's out there for the company. I don't know whether this is going to happen tomorrow or 6 months down the road, but our intention is to eliminate any overhangs it's out there. But we're still discussing the plan and how we're going to approach that, because it's a bit early, but we will try and execute some strategy soon. We're just a little bit reluctant in opening up right now because we're discussing it in a greater context.
No, I appreciate that, and thank you for your answer. Part of the, people view buybacks as a potential way of, creating shareholder value. Can you talk about, potentially returning some cash to shareholders through a dividend and how you're viewing a dividend? I think you said distributions before, and that seems to imply that you're thinking about or you're considering a dividend at some point in time.
Surely we're considering that, but we want to take a responsible approach towards dividend, because for us it's not to start throwing money here and there before we can have a sustainable approach on whatever we do. So we want to make sure that whichever way we choose to follow, we will be able to carry this through for the foreseeable future. So the answer is yes. The dividend is top priority for us, together with the previous ideas we were just discussing, but we want to do it on a sustainable basis and not to lose face 6 months or a year or 2 years down the road if we cannot really keep up with it. So we want to make sure that whatever we start, it's going to be sustainable for years to come.
Okay. And then can you, Stamatis, or can you highlight sort of what your, the biggest concerns that you see out there as far as when you get questions from shareholders? I think we've covered, a lot of the issues, but anything that you think we've missed?
Well, as you know, shipping historically has been an industry full of black swan events, so nobody can really foresee the future. What has been historically the biggest party spoiler in shipping has been the increase of supply of ships. In good markets, people were always rushing to build new ships, and this tsunami of additional tonnage when it hit the water kind of created this severe drops in freight rates. So demand for seaborne transportation services have been quite stable over the last 30, 40 years. It has always been going up, so we're not worried about demand for shipping. What we were always worried, and what has spoiled the parties in the past, has been new building activity and new tonnage hitting the water. Right now, as I mentioned before, for the foreseeable future, we don't really see that as an issue because of the environmental regulations coming up. So there's an artificial environmental lead on top of the shipbuilding activity, and that's why you don't see any serious shipbuilding thoughts so far. So supply of ships is always an issue. We're not concerned about demand in the near future, but that supply potential problem, we don't expect that to be a serious concern due to the environmental reasons that we mentioned before.
Yeah, I think I saw this morning that Golden Ocean, is building 3 Kamsarmaxes, but
Yes.
as I think you and others have highlighted, you're looking at deliveries that would be potentially in 2024. And because the shipyards are pretty full, the container market order books has, materially increased, and that's, potentially pushed out any dry bulk construction into the out years. Is that fairly accurate?
Well, Paul, to be honest, in let's say 10 years before, if the market was at $40,000 or $50,000 a day, instead of 3 new buildings, you would see 10 plus 10 plus 10 plus 10. People would go crazy and rush into the shipyards. The fact that you see 3 new buildings here and 3 new buildings there, and maybe 5, around the corner, it's not really anything serious. From the Capesize perspective, right now there are 1,700 capes in the water. So when we have the speed reduction coming up in 2023, 15 to 20% of that effective capacity is going to be reduced. So this is going to create a gap of 250 or even 300 ships. So as you can understand, a few ships here and a few ships there, it's not a risk into the market. It's anything but that.
Yep, understood. Yeah, it is, as you mentioned, it's always it typically is the supply side that, creates the downturn that's lasting, that, we'll see ebbs and flows in demand that move rates around, but the real downturns really come when you overbuild the market. Anything else, Stamatis or Stavros?
Well, I don't know if Stavros wants to discuss a little bit about the balance sheet and the capital structure going forward, and what we expect to see the interest expense reducing and all that from next year.
Of course. I mean, from next year, I mean, we have, as you know, in the balance sheet from the old legacy expensive facilities, we have one remaining, which is financing two of our ships. This we expect to refinance early in the next year. And from that point onwards, we expect, I mean, our interest expense to normalize to around 4.5% all in throughout our debt. As we continue taking delivery of ships, I mean, we took delivery of the World ship last week, and we're financing them very conservatively. We expect leverage to continue to stay below 50%. And this will have a direct reflection, I mean, on the value of the equity of the company. Otherwise, as Stamatis said, I mean, the focus is threefold: convertible, buybacks, new vessel acquisitions. And this is, I mean, where we're going to be focusing in the next few months, and we hope and we think that the market will be sustained at this level, which will eventually lead to dividend distributions, so that, I mean, the shareholders that have supported the company through thick and thin over the last 3 years can see some serious returns, I mean, in their pockets.
Great. Stamatis, we did get one last question in, and my crystal ball has always been a little cloudy, but this person's asking for your prediction on the BCI 12 months out as we look into exiting 2022 and in front of the EEXI rates regs that'll come in January 1st, 2023. Any prediction that you'd like to offer?
With the usual disclaimers and safe harbor language, I think that 2022 will see a market that we hope to be above $30,000 a day as an average. And the closer we get to Q4 of 2022 and then Q1 2023, we'll see the market rising again. There will be volatility, there will be ups and downs, but everybody's going to be very happy if the market is sustainably above $30,000 a day. My wish is for that to be over 50, but you can see in the containers, 50 is a small number these days. So why not on the Capes? The fundamentals are pretty much the same. Supply is very low, demand is very high. So why not see 50 on a sustainable basis? But let's play at 30 plus just to be on the safe side for my predictions.
Yeah, generating 20,000 plus a day in cash flow, off your cash operating expenses wouldn't be a bad thing. That you sort of compared it to, container market, and the one thing also that's a little bit different in the container market is that you have multi-year terms out there. Do you envision the dry bulk market or the Cape market, getting to the point where you see multi-year terms, on the time charters at set rates, or do you think it's going to be more of a mark-to-market market?
Well, if I was a charter and I was there to export 300 million tons a year, like Vale, BHP, and Rio Tinto, I would definitely try to lock in as many ships as I can in the next few years, even if I can find them at $25,000 or $30,000 for the next 3 years. We're very prone to fixing additional tonnage, and as you know, we have fixed 2 of our ships in mid $31,000 a day, which is higher than other public shipping companies that have been fixing in the mid 20s. So, we have done a very good job in fixing period rates. We will continue looking for more and more period market. And I think that the charters, once they realize what problems are coming ahead of them with the reduction of the supply, they will start fixing more and more for period deals. It's going to happen. It's just the nature of the business is different, but the demand and supply fundamentals are so much alike like containers, and we expect to see that happening for us as well.
Yeah, what I saw that Diana fixed wanted just a little bit over 27 a Cape, for a year. So your rates are about 15% higher. So congratulations on that. With that, Stamatis and Stavros, we'll wrap up. I appreciate your time. You did a great job and very comprehensive presentation and great Q&A. So I really appreciate it. Thank you so much.
Thank you very much. Great seeing you, and hoping that we can meet each other sooner rather than later.
Absolutely. Thank you.
Thank you for joining us for this virtual roadshow presentation brought to you by ChannelChek. View our YouTube channel for more video content, including C-suite interviews, virtual roadshows, and conference presentation replays. New content is added regularly, so subscribe below to stay up to date. Visit channelchek.com or click the link in the description to access equity research, news, and advanced market data on this and 6,000 other small and microcap companies.